A very good afternoon, a good morning. Welcome to HYCM's live trading workshop with myself, Giles Coughlin, Chief Currency Analyst here at HYCM. Very warm welcome to you. There is a lot to cover today, and we have the geopolitical risk, which is front and center. So we will be covering the geopolitical risk from the very outset. And I'm just going to quickly run through where we are. We also have a lot of significant central bank meetings this week. The Reserve Bank of Australia, the Bank of Canada. We have inflation data out of the Eurozone. We'll also be covering oil and gold. So we were making clear exactly what to expect. So don't forget, particular welcome if you're new to the video. I can see a lot of very lovely familiar faces and names here. Warren, good to have you. Gary, great to have you here. Hussein, Jabin, Salvatore, Stefan, Richard, welcome. Jabin, Hussein, welcome. So really looking forward to getting us through the session and getting us totally clued up what's going on in the markets. So without further ado, let's get going. Now, markets started risk off this Monday. And it was for very predictable reasons that the market started risk off, because we've seen a series of negative headlines over the weekend with Russia escalating the invasion into Ukraine and Europe, the US, Japan, countries around the world increasing their sanctions on Russia. Now, we had the ruble fall nearly 30% at the open this morning, and there's been a number of countries which have put restrictions on Russia's central bank. Their assets have been frozen. They're not allowed to make a lot of transactions, and we've seen even significant companies with BP exiting the Russian Rosneft holdings. We've seen the Norwegian Sovereign Wealth Fund, which for those of you who don't realize, it's a huge kind of equity holding that Norway has. They've invested a lot of their oil resources and that surplus wealth into this enormous fund, which helps support the economy. They are looking to divest their Russian holdings, significant. Then we have UPS and FedEx, who are stopping their services into Russia. We've had the Eurozone offering 450 million euros of support, huge support offered to the poor Ukrainian people. And the that risk sort of off start that we saw to start the day has been fading on this one headline that Ukraine and Russia are in the process of having talks. Now, this is very significant how these talks go. So you can see we've been seeing equity markets, being bought. Remember, equity traders are very sensitive and nervous to risk. So when markets are feeling worried, you tend to see equity markets move lower. Now, if you look at volatility, this is the Volatility Index, which is a quick litmus test of how fearful equity traders are. When this level is high, it means equity traders are fearful. When this level is low, it means they feel more confident. Now, if you just look at the, we'll just put the S&P 500 over the top of this. So if you just take a quick look here, this is the S&P 500. And what you see is, look, when the VIX moves higher, the S&P 500 falls. When the VIX moves higher, S&P 500 falls. High VIX falls. High VIX falls. So the high VIX that we saw with the Russia-Ukraine crisis really took off. We saw falls in the S&P 500. Now, when the VIX is falling, we're seeing some gains. So if you want to have a quick idea what's going on in equity markets, take a look at the VIX. It's known as the fear index, and it just lets you know how US equity traders are feeling, and that tends to bubble over to other global financial markets. From a medium-term perspective, China's 850 still is an excellent place to buy. China has a number of pro-growth policies, and unlike central banks around the world, China's central bank is actually cutting interest rates. Remember, when a central bank cuts interest rates, it means that the financial conditions are more beneficial for companies. Loans cost less. Consumers have more disposable income because less of it is having to be paid on interest payments for existing loans and mortgages. And a central bank, by cutting interest rates, can support the economy. Now, you look at China's index, it had sharp falls last year as China's rapid growth slowed, nearly 30%. But now there's pro-growth policies, there's a perspective from China to support the economy going forward, and a lot of significant metals and commodities that we'll be using for the shift to green energy are actually produced in China. Now, I was looking at this and I was thinking, this obviously isn't a tradable observation in the short term, but it is a very helpful observation to show that China does actually is quite well placed for energy markets in the medium term. If you look here, you can see clean energies like copper, nickel, cobalt, rare earth, lithium. All of these are meant to be very strong going forward into the future with electric vehicles, etc., etc. Look where those metals are processed. This huge amount processed in China. Look at rare earths. 60% of rare earths are actually produced in China, and nearly 90% are actually processed. So this huge advantage that China has, and really it's across the board in terms of processing. And if we do see a big demand for these metals over the medium term, look, China does stand to gain from that pivot. So China is really leading the process in this green revolution. So over a medium-term perspective, China's A50 does look a good area to enter. Now, you have to be aware of a couple of things. So one, where would you put your stop? So stops could be easily placed just underneath that 14,400 region. So you could buy at market and stops just under 14,400, just around that 14,386. And if that level breaks and stop gets hit, this is a very strong demand level here. Can you see the way? Do you see the way price aggressively accelerated from this region? That means that there's probably some existing orders still sat there. So if we did see a retracement back down towards 14,100, you could expect buyers and stops could be nicely placed just underneath sort of sub 13,300. So that's the thing to look at with China's A50. It's a medium-term opportunity that does remain still very much there in the markets. Now, looking at the currency space, you can see that markets started sort of risk off, but now they've made a more risk on tilt. You see that the high betas, New Zealand dollar, Australian dollar, are the strongest now, and we've got weakness in the US dollar and Japanese yen. That's on the risk positive sentiment because Ukraine and Russia are having talks. That could result in some significant upside for risk. Now, this is the trade at the moment. So it's just simplest that I just run through this. Now, this is my Twitter feed, and I've just put up a tweet on my Twitter handle that really outlines what we'd expect if we did see a Russian withdrawal. So what we're looking for is two things: a Russian withdrawal or a ceasefire. They are the two outcomes of the talks that would result in risk positive trading. Okay, so a Russian withdrawal or a ceasefire. So if the Russians withdraw, we'd expect the euro US dollar to gain, the US dollar to fall. So you'd expect upside in the Aussie US dollar, New Zealand US dollar, expect downside in oil, downside in gold, and you expect New Zealand dollar yen and Australian dollar yen pairs to rip higher. And actually, New Zealand dollar yen upside would be my favorite risk outlook. And the reason I'm so positive on the New Zealand dollar Japanese yen pair is because of the shift we've seen from the RBNZ. Now, the RBNZ met, last week, and they have taken a more hawkish stance. Okay. heading into the meeting, the New Zealand dollar found buyers. They expected the central bank, we were expecting the central bank to be more hawkish, and they are. Why? They've got soaring house prices, inflation's at a 31-year high, unemployment is a record low, got a really tight labour market. All of those meant that, yes, there could be a 50 basis points hike. Now, in the end, it was just 25 basis points, but many members saw a case for a 50 basis points rate hike, so that's hawkish. And they've revised higher the official cash rate projections. So they were seeing interest rates at 2.4%. They now see it at 2.84% for June 2023. The terminal rate is now above 3%. They can see that March, 2.57%, previously it was 2.3%. So they've revised all their revisions higher, and we've seen a lot of New Zealand dollar weakness into this year. So the New Zealand dollar is really primed for a breakout. So that's why I favour New Zealand dollar Japanese yen buying, okay, above that trend line here. So if we see risk sentiment turn positive, we would expect more New Zealand dollar yen upside. And I'll just show you where we're at with that. So here's the daily chart. Here's the weekly trend line. Okay, we've got to break up that weekly trend line. So stay above, stay with. Now the risk here, the reason you can't just enter at market now is because we don't know what's happening. So it's best to wait to see if there's a positive outcome. And remember the two things we're looking for right now. One, we're looking for a Russian withdrawal or a ceasefire. Now, both of those should result in significant Australian dollar, Japanese yen upside and New Zealand dollar yen upside. But we favour the New Zealand dollar yen because the RBA are meeting later tonight, and we'll cover that in a minute. Okay, so that's my preferred risk-off trading. But don't forget, we'd expect all these reactions from the Russian withdrawal or a ceasefire. Now, what I'm using at the moment is an audio squawk. I just put it on.
Might still do that.
Do you see that audio squawk?
Address.
Now that audio squawk that you heard, that other man's voice, is a resource that we can have access to at HYCM, and this is the new squawk that professional traders use. So if there is an update, I'll keep the new squawk on. And if there's an update, okay, you can certainly hear what's going on with the update. And they will tell you whether there's a, if Russia's about to withdraw the troops, you'll hear that, and then you'll instantly see the currency pairs react. So the way I'm trading this at the moment is I'm waiting and I'm listening. And if I hear something positive on risk, then I can jump into the Australian dollar yen or the New Zealand dollar Japanese yen. Okay, because I know.
Worth noting as well, while Putin is speaking, just seeing a lot of journalists just to report some news from earlier today. Finland to send lethal arms to Ukraine, and also the Swedish PM getting a bit of attention as well. Yesterday, he announced a historic decision.
Right. So what's going on? President Putin is speaking, and that's influencing markets, right? So when things are significant, there is a skill to trading this news squawk. You don't just trade any kind of decision, okay? But there is a skill to trading it. And if you hear, Russian withdrawal, peace in Ukraine, anything like that, you'd expect Aussie yen, New Zealand dollar yen upside. Now, I'm going to give you a link, and the link will show you some more details of that financial source terminal. It's very helpful. And sometimes HYCM clients can get access to that. I'll just put it in the chat box, and you can look at that. But the reason I'm telling you about that today is because this is the kind of market environment where it's really helpful to have an audio squawk, and you can get sometimes like really good opportunities. Now, there's a real skill in trading geopolitical events, and I do run through that here in my blog. Now, this blog here, blog.hycmlab.com, is my personal blog, okay? And in this, I've done a video, and you can see this video, and you can see, like, if you just press play on the video, you'll see a picture of me. I'll turn up. One moment. and I'll just send you the potential incursion. There we go. So there's a picture of me. Okay. No comments on how handsome I am. Thank you very much. But there's the chat box. I put it there, and I explain you how you use a news squawk in trading geopolitical events. Now, if you're new to that, that will be an insight. If you're already used to trading geopolitical events, then that's just a good little reminder. But it's a good resource, and it's really relevant at the moment because of the massive focus that we've got on geopolitical events. Right, well, that was a very long introduction, but it's important, okay? So if you've got any questions about anything I've been saying, put it in the chat box, put it in the question box. We'll now look at the upcoming risk events for the week. Now, the geopolitical risk is the #1 risk. But remember, once that fades, the market is going to go straight back into the big narrative that the Fed is hiking interest rates too quickly as growth is slowing. So if this Russian risk fades, we'd expect immediate upside in equities, because remember, geopolitical events don't tend to see much of a reaction. Now, if you look at my Trading Insights page, you'll see this article here, the geopolitical playbook, what's the trade, right? And in this article, you can find it on my blog, just on the Trading Insights. I go through how little markets tend to react to geopolitical events. Do you see that sometimes stock markets actually gain on geopolitical events? So you can see when the London subway bombing, when there was the Suez crisis, and when there was the Yom Kippur war, the S&P 500 actually gained on the one day, all right? And sometimes the recovery can just take 1, 2, 3, 4 days. So on average, the general market reaction to wars, as the human price is terrible. It's a deep sadness that obviously we have for this terrible crisis. But in terms of the financial impact, it tends to be limited. So that's why those dips, right, found buyers. It wasn't a surprise because medium-term buyers were looking for opportunities to go long, to buy into those dips. And they're looking, over sort of 3, 4, 5 weeks, they're expecting equity markets, to have a strong chance of recovering. So if this risk market fades, that's one thing to be looking at. But as soon as that happens, remember, any buyers will need to be aware that the focus will go right back on the Fed and whether the Fed is hiking interest rates too quickly or not. Right? So that's, you got the two narratives. With all that being said, we'll now look at the economic events, trading events. The first one to look at is the Reserve Bank of Australia. Now, the Reserve Bank of Australia are meeting overnight tonight UK time. Okay, now this is interesting. Now, the Reserve Bank of Australia have a big focus on wages. Now, at their last interest rate meeting, and you can look at the central bank decisions, just go to my blog, you can look at Central Bank Watch, okay? And you'll see that under the Central Bank Watch, I cover the central bank's meetings, and also under trading calendar events, I outline how to trade the RBA meeting. So this is the RBA meeting that's coming up, right? And I outline how to trade it. Now, let me just run through with you what the issue is here. The Reserve Bank of Australia have had a number of tests that they wanted to see reached before stopping their asset purchase program. That's been achieved. But they're not confident that inflation is sustainably within the 2 to 3% target. Why does that matter? Because that's what they need to hike interest rates. And when a central bank hikes interest rates, it increases the value of the currency. So the last wage price index meeting came in at 2.3%. Now, if you notice, this was a key calendar event we were looking at, which was the wage price index, okay? Because the wage price index are key for the RBA to hike rates. Now, what the RBA have said is they want to see the wage price index at 3%. It's currently the wage price index at 2.3%. So, yes, the wage price index was higher than the recent lows it's been. Yes, the wage price index was like a multi-year high, but it's still not that 3% level. So the RBA almost certainly doesn't have enough, according to their own criteria, to hike interest rates. So they're not expected to hike interest rates, but will they be more hawkish? If we get any sense of more hawkishness from the RBA, expect Aussie US dollar upside as long as risk remains positive. So if risk remains if risk turns negative, that means there's an escalation in the Russian conflict. If Russia uses nuclear weapons on the battlefield, which is not necessarily as totally scary as it sounds, you can use sort of moderate nuclear weapons in a battlefield scenario, which the Russians have as part of their arsenal. Very horrible warfare, but it is possible. It would up the ante. If obviously Russia detonated a nuclear missile, you could see the scenario where Russia would launch a nuclear missile, say in between the UK and Denmark above the North Sea. So if, you know, to sort of warn markets and warn different countries. So as long as risk remains positive, then you expect Aussie US dollar upside. If the RBA are more hawkish, then you'd expect Australian dollar, Japanese yen gains, Australian dollar, Swiss franc gains as well. Okay, so that's what's to look for heading into the RBA meeting. But the market will be focused on their kind of hawkishness. Now, Financial Source is a great asset, and I'm one of the analysts here at Financial Source with a great team, and this is something we have access to as HYCM clients. Now, the key thing to be looking at here is large speculators. See, the weekly COT report shows there's a huge amount of Australian dollar shorts. Now, those shorts look very stale. So in other words, there could be a good opportunity for them to unwind. So this is how you use the COT report. You're looking for a situation where people are heavily biased one way, and you can see that large speculators are heavily biased Australian dollar short. That looks old now because China's recovering, pro-growth. We've had a more hawkish potential for the RBA. They didn't take that opportunity last meeting. So any hawkishness from the RBA and any hints of, like, if they talk about rate hikes coming, then expect Aussie US dollar upside. You'd expect Aussie Swiss franc upside, Aussie yen. But if risk markets turn sour, if, you know, there's a problem in Russia and Ukraine, it flares up, then you expect these dips. But I'd expect dips to be bought medium term. So then it's just a question of where do you define and limit risk. Okay, so the obvious area to define and limit risk in the near term, underneath 80, and then underneath 78 at 50 for like the Aussie yen, for the New Zealand dollar yen. You know, you want to just keep risk underneath that sort of 74.50 region. Okay, and you're looking for a move back up towards that 81, 82 area. So that's the RBA meeting, big meeting. Wednesday, we have got the very important inflation data. Now, the inflation data out of Europe is going to be absolutely key. If the inflation data comes in very low, then you'd expect to see some euro downside. But at the moment, the ECB is expected to announce the end of their asset purchase program in September, or the third quarter of this year, and then to hike rates once. Now, the Eurozone is very sensitive to inflation. So if inflation is still a problem for the Eurozone, we could easily see the ECB turning more hawkish out of Wednesday's meeting. So this is going to be crucial, this inflation meeting. We have to also remember geopolitical risk, because if the Russia crisis is still going on, then that can impact the euro, and that weakens the euro. So remember, if the geopolitical risk is still going on, that causes the euro to show some weakness. But if that fades, then the inflation data becomes crucial. If it's high, so if it sort of comes in, the core CPI comes in like, say, like 2.8%, 2.9%, anything like 3%, then that will increase expectations for the ECB to hike rates. that should support the euro. If it comes in very low, say it comes in like 2.2%, 2.1%, then that will take the pressure off the ECB and you're likely to see more euro downside. But that's crucial, this CPI data that's coming up. We've also got the Bank of Canada, the interest rate meeting. Now, Canada meets on Wednesday, and the expectations will be important for the ongoing path of the Canadian dollar. The Bank of Canada, they've clearly signaled that an interest rate is coming. On February the 9th, Governor Macklem stated that by signaling a clear intention to raise rates, it hopes to ensure people that inflation will come back down to target. So the Bank of Canada is going to hike rates at this meeting. So that means if they don't hike rates, you'd expect immediate weakness in the CAD. Okay, so something like, you know, so US dollar CAD upside would be an immediate reaction. So if they don't hike rates, expect immediate weakness in the CAD, and that's a tradable opportunity. If they do hike rates, then it becomes what the forward projection is. At the moment, the market is pricing in about 6 rate hikes this year, which seems far too steep. And the risk here is that the Bank of Canada fails to deliver on these hawkish expectations, and the forward projection will be crucial for market pricing. Okay, so what will be in focus is how are they doing, what are they expecting to come. The tradable opportunity out of the event is if they don't hike rates. If they don't hike rates, immediately expect CAD downside. If they do hike rates, then look at the forward projection. If they end up kind of saying, oh, we may not be as aggressive as the market is thinking, then that initial strength could fade. So you can see CAD strength on the rate hike, and then if they seem more dovish in the meeting, then expect the CAD to weaken. So watch out for the Bank of Canada interest rate meeting. Then don't forget Governor Macklem will be speaking the following day, so watch out for Governor Macklem either confirming or contradicting what is said in the interest rate statement. We've got Fed Chair Powell speaking. Again, market will be looking very carefully to see what Fed Chair Powell says, particularly about the future path of Fed interest rate hikes, how the Fed's going to respond to the Russia-Ukraine crisis. You know, it's going to be in absolute crucial focus. And then we've got non-farm payroll on Friday. This will either be very important or not so important, depending on what's happening with geopolitical risk generally. Okay, if geopolitical risk fades, then we would expect to see non-farm payroll in important focus, and obviously a weak reading here would be a concern for markets because they'll be worried that the Fed is hiking just as growth and employment is slowing. Okay, so that would likely result in downside in equities, although we have to just be careful with the reaction at the moment because of the number of different drivers there are. And obviously if the geopolitical risk remains, then that will be in focus, not the non-farm payroll. So with all the different events we've looked at, the most important event this week is the European inflation data, because that will be key for what the ECB are doing. And the most important pair will be looking at trading the euro-pound pair. Okay, so the best opportunity potentially rests with the euro-pound. I'll just show you why that is. Now, you can see the euro pound, we've got this sort of strong demand level, finding some support. Now, it's not that the pound is bearish, okay? The pound is more peak hawkish. So the Bank of England has been hiking rates. They're trying to hike rates to control inflation, but they're kind of peak hawkishness now. Whereas the ECB are starting to turn slightly more hawkish. So it's kind of like, let's see, we're kind of getting this scenario going on. That I'll show you. Right, so if you imagine like a turning point, okay, it's the fact that the Bank of England, they've sort of passed their peak hawkishness and they're coming lower, so they're at this kind of area, whereas the ECB have been very bearish and they're just starting to turn more hawkish. So we could see some euro pound upside out of that inflation data. And that will be particularly if the inflation is very high. If it comes in above 3%, we'd expect euro pound upside as long as the risk profile is positive, as long as risk hasn't turned negative. Okay, so we have to keep an eye on what's going on with those talks. Okay, folks, it's a bit messy today, and I apologize for that, but it's because of all this geopolitical event that we have. Seeing a bit of movement in the market now. I'm not sure what's moving. It's just see the Aussie yen jumping up and down. I wonder if there's a headline that's breaking. I'll just check out to see if it is. No, there's nothing obvious, but just seeing a little bit of movement in the Aussie yen.
In response to the sanctions, Russia is barring airlines from 36 countries, including from European countries, from Canada as well, from flying to Russia. That's according to Russian news agency Interfax.
Right, there's nothing obviously that's jumping out, but I just wanted to check that. Okay, folks, take care. Have a really good trading session. Don't forget, I'll be back here on Wednesday, and we will unpack the RBA. We'll also unpack what's happening with the Bank of Canada meeting and also the European inflation data. Take care, everyone, now, and have a great week. Thanks, everyone. Goodbye.